If I'm right about recession, denier, capitulation this year, that could cause silver to underperform. And, big surprise, silver underperforms gold at first and then catches up at the end. I still think we'll see that pattern, but it makes me nervous about speculating more on silver now. If I see a great pick, I'm still willing to do that. There's so few, but I'm the answer to the question is I'm more comfortable betting on gold than silver at this particular moment, though I see more upside in silver when it does one of those whipsaws at the end, as this plays out.
Gold is widely recognized as a reliable safe haven asset, consistently performing well during recessions. For example, between 2007 and 2011, gold doubled in value amid significant market turmoil. Both gold and silver exhibit resilience during economic downturns, though their performance can vary due to market dynamics and investor sentiment. Lobo Tiggre is a financial analyst and commentator known for his expertise in precious metals and economic trends. He provides insights on market dynamics, particularly on gold and silver investments. Tiggre suggests that while silver might initially lag if recession deniers capitulate, it will eventually catch up to gold. He remains cautious about investing further in silver due to limited opportunities, but is open to strong picks. Historically, silver has outperformed the S&P 500 during several recessions, benefiting from periods of uncertainty, though its volatility makes future performance less predictable. Tiggre explains that before 1971, gold was not merely price-controlled. Instead, the dollar was defined by a specific amount of gold rather than being backed solely by the U.S. government's good faith and credit. This transition becomes evident when examining the 1970s, a decade marked by a dramatic surge in gold prices. From 1971 to 1980, gold prices soared from $35 to $850 an ounce, driven by oil crises, rampant inflation, and international conflicts. This substantial rise underscores gold's role as a hedge against economic instability and uncertainty. Tiggre also adds that since the 1930s, private individuals could not redeem paper money for gold. However, international settlements remained redeemable, so Richard Nixon ended gold convertibility for foreign governments like Charles de Gaulle, who persistently demanded gold instead of paper money. Before diving into the video, subscribe to our channel, hit the bell icon for updates, and share it with anyone who might find it helpful.
I'm bullish on silver. I'm happy to see that it's been acting more like a monetary metal should. And for anybody who's missed it, the point there is like, well, duh, silver and gold, they go together. They correlate highly. Of course they do. But last year, silver was correlating more with copper than with gold. Its industrial side is stronger than ever. That doesn't mean it's not a monetary metal, but it does mean that you can't ignore this market dynamic. The industrial side is stronger than ever. That matters. And people get mad at me for saying this, but this is, I think on the other side of the recession, this is even more bullish for silver. It's the win-win metal because as a monetary metal, it responds to the turmoil. As an industrial metal, when the money helicopters fly, and it responds to that wildly inflationary scenario that we see following the crisis. But before going into the recession, does it act more industrial? Does it act more monetary? I don't know. Nobody knows that. This is the first time we've been in this situation, and we'll just have to see. It's just, it is worth being cautious, though, because, look at what happened in 2020. Gold and silver got whacked. Gold comes screaming back, and silver still has yet to hit even a nominal all-time high. So, you can ignore that. You can say, oh, it's just one off, but it is the most recent data that we have. So I just think it's very dangerous to ignore that. And again, I'm not a bear on silver. I'm just saying that going into this recession, if I'm right about recession, denier, capitulation this year, that could cause silver to underperform. And, big surprise, silver underperforms gold at first and then catches up at the end. I still think we'll see that pattern, but it makes me nervous about speculating more on silver now. If I see a great pick, I'm still willing to do that. There's so few. But the answer to the question is I'm more comfortable betting on gold than silver at this particular moment, though I see more upside in silver when it does one of those whipsaws at the end, as this plays out. The 1970s, if I'm right about recession and inflation is still high, then that, rhymes with the stagflation of the 70s. And I do think there'll be an element of that out there. It's the closest analog, perhaps. But really, things are different. When we went into the 70s, remember that it wasn't, people say, oh, well, so gold was price controlled. That's the wrong way of looking at it. Gold was still, until 1971, the definition of the dollar. The dollar wasn't just this, good faith and credit of the United States government. It was defined as a certain amount of gold. And private individuals couldn't redeem their paper for money, or real money, not since the 1930s, but international settlement was still redeemable. And that's why Richard Nixon closed the gold window on Charles de Gaulle's fingers. He kept asking for the gold instead of the paper. So you could call it Cold Spring. You could call it the unwind of an artificial trade. There's a lot of ways to look at that. But the 1970s bull market was, the basis for it, for precious metals, I hate that expression, monetary metals, is different from now. We don't have that circumstance. And there are other things that are different too. There's similarities, oil shock, there are things like that, war in the Middle East.
Tiggre notes that gold has not only surpassed $2,500, but has also maintained weekly and monthly closes above this level. A typical 20% rise from here could push prices close to $3,000, drawing substantial media attention. Bank of America strategists have recently reaffirmed their prediction that gold could reach $3,000 by next year. Since late 2023, their commodities team has remained bullish, projecting that gold prices will hit $3,000 per ounce by 2025. This aligns with Tiggre's observation of increasing gold prices and underscores a broader consensus on gold's upward potential. Tiggre also notes that gold stocks, which had previously lagged gold, are improving. This closing gap, like alligator jaws narrowing, signals a broader upward potential in gold prices and indicates that gold stocks are catching up with the metal's rising value. Let's get back to the video.
Historically, going into a recession like this is bullish for gold, and gold doesn't pay interest. So the Fed cutting rates is bullish for gold. Surprise jumbo rate cuts are bullish for gold. And we're going into that at an environment of nominal all-time high prices. So that's extremely bullish for gold. I mean, the gold is making headlines now. It closes not just, a little spike over 2,500. It makes weekly closes over 2,500. We had a monthly close over 2,500, and just 20% higher from here, which would not be a big move in the gold market, takes us close to 3,000. You don't have to imagine. Just think about the headlines on the way from 2,500 to 3,000 with gold already making headlines. It's the sort of thing that attracts a lot of attention. And I think I've said this on your show before. I think we're getting to the point where it's demonstrated. We're seeing this in action. The gold stocks have started perking up. There's been this huge underperformance, alligator jaws opening, right, between the gold, the metal itself, and the stocks. And we are seeing the stocks starting to perk up. The big producers in Q1, they all beat. Granted, the expectations were low, but they all beat. And Q2 is already starting to look good, the results here. So the actual business of gold mining, which so underperformed in the last cycle, is looking much better this time going around. You combine that with the headlines we'll get out of new nominal. It'd take a fair amount to get us to a real all-time high. I think that would be well over 3,000. I haven't done the numbers recently. I think the last time I looked, it was 31 and change, close to 30.
Is that on an inflation-adjusted basis or versus M2?
Yes. Yeah.
Okay.
Well, CPI, for whatever that's worth. That's giving the other guy the benefit of the doubt. Using my enemy's statistic makes me less vulnerable to criticism of, oh, you're exaggerating. So if I use the CPI and I adjust the previous all-time high, I haven't done it for a while, but last time I did, it was over 3,100, which is actually not that far from where we are now. That's less than a 30% change. Anyway, the stocks are starting to show some life here. And that's important because they're still relatively on sale. They're starting to show some life. And we're going into a circumstance where, if I'm right, the headlines are going to bring generalist investors in here. People are going to start looking at what's working, and gold is going to be one of those things that's working. I think that's extremely bullish, and it's an opportunity. That's the answer to your question. So how do we play this? Of course, gold bug likes gold stocks. That's not much of a great headline. But the case I'm laying out here is for, I think, a pretty unique opportunity where the metal is already up and it's showing great strength. This isn't a wild speculation of, there's going to be more inflation, more money helicopters, maybe gold will go up. It is up. So I think that's as close to a no-brainer in the resource sector as you get. Where you want to go from there, I'm not sure, but that's number one. The number two would be avoid industrial minerals. If I'm right, even the oil patch has been starved for capital. I get it. It makes sense. I am an oil bull. I'm extremely bullish on copper, but nothing like that. No industrial minerals until after I'm sure the recession has done its worst, or that I've been proven wrong. One or the other. There'll be money to be made afterwards, and there's no need to be picking up pennies in front of that steamroller.
Gold has exceeded $2,500, and a typical 20% increase could bring it close to $3,000. Concurrently, silver, known for its historical outperformance relative to the S&P 500 during recessions, demonstrates resilience, although its volatility makes future performance uncertain. As both metals show growth potential, these trends suggest a favorable outlook for gold and silver amid shifting market conditions and changing investor sentiment. How do you think gold and silver will perform in the coming months? Drop your thoughts and predictions in the comments below. We'd love to hear from you. If you found this video insightful, don't forget to like, subscribe, and hit the bell icon for more updates. Stay tuned for more in-depth analysis and the latest trends in the market. Thanks for watching and see you in the following video.